Gautam Duggad joins us, Head of Research with Motilal Oswal Securities. Gautam, I'm sure at the current juncture, given what world is doing and where we are, your clients are asking you tough questions. How are you telling them to stay calm and keep calm and not lose their nerve?
Hi, good morning. See, Nikunj, these are times where the underlying uncertainty has gone up significantly on multiple fronts, both on domestic as well as global. And at the same time, volatility is very elevated, especially in mid-cap and small cap. Actually, Nifty is hiding the real pain in the broader markets. So our stance since last year and a half has been very simple: to stay close to stocks with higher earnings visibility. In fact, fundamentally, I feel now mid-caps are offering relatively better risk reward, especially on valuations. But I also recognize the fact that mid-caps need a better investment climate as well as sentiments in the market. But now they're trading at a 14-15% discount to the large caps, which is not the case in entire 2017 and large part of 2018. Otherwise, the market remains heavily polarized in the favor of 10-12 stocks. If you look at Nifty from December 17 to current period, we have seen 30% return in top 15 stocks if you construct the index of only those 15 stocks. And the rest 35 stocks index is declined by 11%. Same is the case in mid-cap also. You have seen top 15 stocks index up 8%, rest 85 stocks down more than 21%. So it makes sense to stay very cautious, as it is valuation is not offering you any respite, especially Nifty at 20 times 1 year forward, and elevated risk for earnings downgrade now, be it auto, be it consumption. So banking is the only sector which is providing some relief to the earnings next year, that too on a low base, but that's where the things are as of now.
Gautam, we may argue and say, okay, you are being charitable when you say 30 stocks are moving higher. I would say only 15 stocks are moving higher. But if those 15 stocks are moving higher, I would say that, look, that's an easy market to predict. Let's be with those 15 stocks, whether it's a Titan or a HDFC Bank or an ICICI Bank or a State Bank of India. I've said 5 stocks already. I mean, life is so simple. Don't worry about Donald Trump. Don't worry about what is going to happen to India. Don't worry about budget. Just stay put on those 15 stocks and just, go for a holiday.
Yeah, I wish that kind of approach would work in markets over a long period of time. It does work for a couple of years, and it has been working for the last 2 years. The problem, Nikunj, however, is the lack of earnings pickup in a broader sector of the economy. If you dissect Nifty, for example, for FY20, out of 600 rupees of EPS from 480 in FY19 to 600 in FY20, 70% of the incremental earnings growth in Nifty for FY20 is coming from BFSI. And rest 10% is coming from auto on a low base, which I think will get cut as we move closer towards FY20. So the problem really is sectors where there is earnings growth, those stocks are supremely expensive, and sectors which are offering some sort of comfort on valuations, you're not getting earnings growth there. For example, look at ITC. It is trading at 21, 22 times now, almost at a 40% of valuation of HUL. And we've had a very moderate neutral call on ITC for last 4 years now. But even now, when you look at earnings growth projections for ITC, it is at around 10-11%, which is okay. But the market is terrified of any potential tax hikes that could come either in GST Council or outside of GST Council. And therefore, the stock refuses to budge despite 8-10% earnings growth. So we might see market consolidate in this range, and few sectors will keep trading at a premium till we see a slightly broad-based earnings recovery in the market and return of confidence in mid-caps and small caps.
To get in a flavor as to what the mid-cap bets are. There's a number of stocks that you guys are bullish on: Federal, RBL Bank, Zensurtech, Indian Hotels as well. Can you just run us through some of the top picks within the mid-cap universe?
Yeah, so as I said, mid-cap index is now trading at a discount. However, if you stretch back last 10 years, this kind of spread between mid-cap and large-cap prevailed only once in June 2013. So today, for example, if you were to just take a rolling return of last 12 months, then mid-caps have underperformed by 15% and small caps by somewhere around 26%. And we had seen similar situation in June 13. The only difference was the absolute valuations were even more beaten down at that point of time, and you could afford to take slightly higher risk. Today you can't do that. You still have to be very stock specific and bottoms up. So from that point of view, our preference is still tilted towards financials and consumption. So what we like in financials, as you just mentioned, Federal, RBL, even AU and DCB, we are still not very gung-ho in NBFC. Even after the recent fall, we are still preferring to err on the side of caution. Consumption side, we are more bullish towards slightly discretionary stocks like ABFRL, stocks like Trend. Those are the names that we like. Then aside of that, then there is a wide mix of stocks belonging to real estate, even auto mid-caps for that matter. In fact, auto large cap itself is trading at such a big discount to now their 5-year average Ps. Even that is looking quite attractive. While we know that the next 3-4 months numbers may not show any positive relief. In fact, we just published a note today talking about June numbers channel checks, and June is also looking like a washout month for autos. So among the other mid-caps, we are still positive on the IT sector, where we currently like Zensar, given their strong execution delivery in FY19, expectations of another strong year in FY20. And real estate continues to look quite interesting now after a long period of being out of the favor. But now you've seen incrementally bad news flow, especially in Bangalore, where government authorities are talking about clamping down on construction given the water scarcity. Otherwise, we like Oberoi, we like Brigade. So those are the mix of mid-cap stocks which we like.
That's interesting. Gautam, also wanted to revisit some of your earlier calls. And, we've been talking about the slowdown within autos. What do you do with an iShare now, given the amount that it's fallen, the fact that it's been beaten down at its 52-week low? Do you add some more positions at these low levels, or do you just exit the stock and put your money into some of the other two-wheeler stories? Many are betting on a revival, and they say that stick with the market leader because that's going to recover the fastest. So Hero MotoCorp is turning out to be the preferred choice.
Aisha, as far as two-wheeler space is concerned, the problem there is in the last 7-8 years, we have seen that every stock has gone through a very struggling period after 3-4 years of good period. And now Aisha has fallen into that kind of a zone. You have seen Bajaj Auto, Hero going through extended period of low returns for last 7-8 years. As far as auto is concerned, our preference is still more towards four-wheeler, given that their expected recovery is slightly better and they will be least impacted within the current spaces from the BS6 transition. Plus competitive intensity relatively remains slightly better in that space. So we like Maruti there. As far as two-wheeler is concerned, yes, iShare does trade now at a 30% discount to the 5-year average P. The problem here is the number which we keep getting on a monthly basis keeps getting one notch lower. So the new normal seems to be somewhere between 55,000 to 60,000 for iShare. We're expecting a double-digit decline even in this month for iShare. So I recognize that the valuations are cheap there, but I don't expect any immediate upside in that space. So we'll prefer to side with four-wheelers. Even M&M is now trading at a substantial discount to its 5-year averages. So those are the two stocks currently that we prefer in the four-wheeler domain.
I'm going to fast forward to, let's say, 20th of June 2020. In next 1 year or next 12 months, we would have seen two budgets. We would have got a complete handle of what US Fed will do in terms of a rate policy. We would have got a complete handle of which way the trade war is headed and how world will react to it. So assuming that on a 12-year month, a lot of events which currently are called as triggers or drags would have played themselves out. Where do you think the markets would be? What could be higher? What could be lower? Which sectors will be lower than where they are currently? Which sectors could be potentially much higher than where they are right now?
Nikunj, I don't expect any meaningful triggers from budget, whether this year or next year. While we are all excited about budget because it's the most hyped up event, what is more important, at least from a near-term point of view, is the Jalan Committee report and how much leeway the government gets to spend the money and where do they deploy that capital. to address your question from a next 12 months viewpoint, a lot of things hinges on where earnings settle finally. Let's assume that we settle somewhere at 570, 580 instead of 600 for FY20, and we get around 15% upside from there for FY21. So you're talking about an EPS of somewhere around 700 rupees for FY21. And if current valuations were to prevail, say in a band of 18 to 20 times, then the market range should be somewhere between 12,500 to 13,500, which is a decent upside. But the problem right now is your earnings visibility is getting lower and lower for a lot of sectors. Automobile, despite a sharp earnings cut for last 6 quarters, we're continuing to see another round of cut in this quarter. Pharma doesn't show any respite. We have a negative view on metals and oil and gas. So if entire earnings recovery is hinging on financials. So I would expect more of the same for next 1 year. Sectors like financials and some segment of consumption doing well. At the margin, I expect slightly better performance from telecom, because I think that ARPUs have bottomed out now, and Bharti has gone for deleveraging multiple ways. So telecom is something where I expect some positive performance coming through. And from an investment / capex oriented sectors, we think that cement could offer a better opportunity. But again, cement remains very small from a point of view of index, and roads, which have been doing well in the first regime of this government, should continue to do well given that the execution track record has been good. So I don't expect suddenly to the investment narrative to shift from consumption financials and quality oriented stocks to value picks or investment oriented sectors.
And Gautam, just to wrap it up with just one final question. We've spoken about the themes and the sectors, but are there any specific names in Midcap where the selling has been intense? It could be a promoter leverage, it could be a redemption from a Midcap fund, or it could be bent in the market where you think that there is a lot of nervousness and markets, or suddenly that franchise is available at a deep discount to its true intrinsic value.
Yeah, so one of the stock that comes immediately to the mind is Emami, where we have seen substantial correction in the stock on the back of promoter pledge. But I think it's a consumer stock end of the day, and the core business doesn't have much debt. The problem only is that there has been a slowdown in earnings even in the core business over there. It's a stock we've liked historically. Stock is available at 20-21 times. Again, stock is vulnerable to a lot of climate related issues. When you 50% of the portfolio is dependent on winter and summer, so those issues impact a lot. Plus they have a higher share of wholesale and rural, and where we have seen some sort of a slowdown in the last 2 years. Aside of that, across sectors we have seen stocks where promoter pledge, higher leverage, or any dodgy corporate governance kind of a perception is there. Those stocks have taken a huge beating, and that's what I was referring to when I mentioned in the beginning that while Midcap as an index is now trading at a discount to the large cap, but unlike 2013 June, you still cannot take liberal risk there, because the environment has changed a lot, and there is a premium being attached to companies with better balance sheet and better perception of corporate governance.
On the show. Thank you so much for taking the time out and speaking with us today.